Hey guys, what's going on? It's your big dreamer and doer, G Dinero, coming to you today with another Wealthy Wednesday. Today we're going to talk about MicroStrategy Covered Call Strategies, pun intended. But first, remember, there's no tax, legal, financial investment advice being given. It's your buddy G Dinero helping you increase your financial literacy to help put you and your family on that path to financial freedom. And before we jump in, if you want to see more content like this, make sure you like this video. Drop a comment below. Tell me what you like best. Tell me what I could do better. And make sure you're subscribed to this channel with notifications turned on so that you see every single one of these videos that comes out. So with no further ado, let's go ahead and jump right in. So first of all, we're talking about a MicroStrategy covered call today. And how do you initiate the covered call itself? Well, you initiate the covered call by buying 100 shares of stock. See, a true covered call is you go out and buy the stock and then immediately sell a covered call against it. You sell a short call against that, reducing the cost of the original buy. So think of it that way. Many platforms like on Schwab, they call it a buy right, B-U-Y-W-R-I-T-E. You're buying 100 shares and writing a covered call against them immediately. So today at the close, this is as of the close today, Wednesday, May the 7th. And at the close today, MicroStrategy was at $392.48. And you have a bullish bias. That means you believe that the market is going to go up. You don't know how high, but you believe that MicroStrategy will be at least $400 a share or higher over the next month. So you go ahead and buy 100 shares of MicroStrategy at $392.48. That would be $39,248. At the same time, so concurrently, you're selling the June 6th $400 call for $26.88. That should say 400 call, but we're talking about covered calls. I figured that goes without reason. So you're selling the June 6th 400 call for $26.88 a share, or $2,688. So at this point, you spent $39,248 and got back $2,688. So think of it as like a cashback offer, right? You hear the Discover Card cashback or Capital One cashback. Well, this is your cashback offer. You're getting some of the initial cash that you outlaid back by selling the covered call against these shares immediately. So that makes your initial break even $365.60. That's $392.48 minus the $26.88 a share you got back for selling the covered call equals $365.60. So you're covered down to $365.60. Well, you have a bullish bias. You think this is going up anyways, and you're comfortable owning MicroStrategy at $365.60, right? You're basically buying it at a $26.88 discount today by doing so. So if MicroStrategy goes over $400 a share on June 6th, your shares would get called away. They'd get exercised. The call option you sold would be exercised. Your shares would go to the other party. They don't get lost. Remember, we've talked about that in previous videos. And you get $40,000 in return. That's the $400 call option times 100 shares is $40,000. So $40,000 comes back into your bank account plus the $2,688 that you made ahead of time, right? Remember, you got that when you sold the June 6th 400 call for $26.88 a share. So you've collected a grand total of $42,688, and you've spent $39,248, or in 30 days, you basically just made a profit of $3,440. Now, I'm going to stop right there. I know many of you are going to say, but what if MicroStrategy goes to 500? What if it goes to 600? This is a defined risk strategy that we're looking at right here. You literally know I'm risking $39,248 minus the $26.88 equals $36,560. That's what you've got on the line, right? We're going to go over the risks here in a little bit, but for this purpose, you are selling the covered call with one intention: 30 days later to make a profit on these shares. So $3,440 divided by $39,248 is an 8.8% profit in 30 days, right? Because June 6th is exactly 30 days away. So if you did this every single month, there could be some money in this, right? We're going to get to that in a second. But we call this a defined risk, defined profit trade, or a limited risk, limited profit trade. You cannot lose more than $36,560 in this trade. That's assuming that MicroStrategy goes to zero and you lose your entire initial investment, right? Which is the $39,248 minus the $26.88. Defined profit is if you did nothing with this, the most you can make from this trade is $3,440. And that's if MicroStrategy closes above 400. And that's if you did nothing else with the trade. You didn't roll it. You didn't buy it back. You literally bought this MicroStrategy covered call, bought 100 shares, sold a covered call against it immediately. If you did this monthly out for a year, assuming, a lot of assumptions here, that you made 8.8% every single month, that your initial outlay was $39,248, that would be an annualized return of 105.6. I just took 8.8, multiplied it by 12, and that's 105.6. So call it 100% annualized return on this, or you took your 40 grand and doubled it to 80 grand. 81,280 to be exact in it, but we're just going to call it 80 grand. So let's talk about risk here for a moment, okay? So what is the risk? So the risk is that MicroStrategy drops below $365.60, and now you're in a true loss. What do I mean by in a true loss? Well, remember, you were covered down to $365.60. You bought the shares for a little over $392. You sold the other call for $26.88. All in, you have spent $36,560. So if that's the case, and it's below $365.60, the call option is going to expire worthless. In fact, as long as it's below 400, the call option will expire worthless. You could always sell another call option then, which lowers your cost basis or the threshold needed to walk away with a profit. What do I mean by that? So, for instance, let's say MicroStrategy was at 350. MicroStrategy drops back to 350. The call option that you sold for June 6th expires worthless. It doesn't make it over 400. In fact, you're in a $15.60 per share loss right now on the trade. So you sell the 375 call option with 30 days until expiration. And let's just say for this purpose, you got $20 a share for that 375. Well, now you could technically say that you've lowered your cost basis down to $345.60 because you collected another $2,000. So instead of spending $36,560 for your shares, you've spent $34,560 for those shares. And if you got called out at $375, you walk away with a $3,000 profit at the end of the day because your call option's up at $375. Your effective price on your shares, because you've sold two covered calls against them, the first one for $26.88, the next one for $20, you've lowered your cost basis on those shares by $46.88 all the way down to $345.60. You don't have to go as far now. You don't have to go all the way to $400 to make a profit. You just need to make it back up to $375, and you're in a $3,000 profit. So I wanted to call this one MicroStrategy Covered Call Options, but all these things are called options, right? But the whole pun intended. So choices. You have some choices, right? You could just let it ride. It's a defined risk trade. You bought the covered call. You're done. Bought the shares, sold the call, wait and see what happens. Or what else could you do with the original covered call? Remember, it was a June 6th 400 that you collected $26.88 on. You can roll it out for another 30 days, right? As we get closer to expiration, maybe you see it starting to make a move up and you say to yourself, you know what? It's just barely going to close above 400 by June 6th. I'd like to roll this out another month and maybe my shares get called away a little bit higher and I collect a little bit more premium in the process. So when do you do this? You do it in the final few days before expiration. Why? You're waiting for the extrinsic value to bleed out of that option. The less extrinsic value that you have to buy back, the better. If you don't know the difference between intrinsic and extrinsic value, don't start asking a bunch of questions down in the comment section. That's what my Understanding Options course is for. So go to gdinerocoaching.com, drop what you're doing, go to gdinerocoaching.com and go sign up for that Understanding Options course right now. So when? Well, in the final few days before expiration is when you're looking to roll. So for instance, let's say on June 4th, MicroStrategy's at $410. And the call, that $400 call option that you sold for $26.88 is going for $15. And you may ask yourself, why is it only going for $15? There's only 2 days left on it. June 4th is 2 days before expiration. It is at that point $10 in the money. That's the intrinsic value. A $400 call option when the share price is at $410 is $10 in the money. There's $5 of extrinsic or time value left on that option. That's where the other $5 in the premium is coming from. So that $15 premium is made up of $10 of intrinsic value, $5 of extrinsic or time value. So you decide to roll it out to the July 11th 410 call. Now I know what you're saying. That's a little bit more than 30 days. It is because July 4th is on a Friday. So I don't know. I think the market will probably close. Those options will probably be July 3rd options. So say you roll it out to July 3rd or out to July 11th. That part right there is relatively irrelevant. You're rolling it for approximately 30 more days of time value. And let's say that 410 call, and by the way, you're rolling it up $10. So if you did get called away, instead of collecting $40,000 for your shares, now you're collecting $41,000. And number two, let's say that price was $25 on that call option. So you have to buy to close the original one that you sold for $15. You're selling to open a new one for $25. The new one doesn't have any intrinsic value, but it has $25 of time or extrinsic value. It's essentially $5 for each week that's left on that option, right? If it's got almost 5 weeks left on it by the time you go to roll it, 4.5 weeks, it's got quite a bit of time value left in it. 4.5 weeks is a lot compared to 2 days of time value. So net, the net additional credit that you received is $10 a share, or approximately another $2.50 a week per share. Hope you're following me on this one. You sold the original one, you bought it back for $15 and sold a new one for $25. The difference between $25 and $15 is $10, excuse me. So now let's take a look at this for income. Remember, I said you have choices. Maybe you're waiting for MicroStrategy to get to a certain number. Maybe you want to just do a one and done, like the first one that we opened up with. You let your shares get called away and you go, hey, I made my $3,440. Or maybe you want to do this on a regular basis, on a monthly basis, because you need to generate some income and you know that you can kick the snot out of MSTY. Yeah, I just said that. Hey, I know what I can do and I know what they can do. Although the dividend was healthy, it was like $2.37 today. Don't think I don't pay attention to those things. And I'm always looking, can I beat them, right? Can I beat them while my underlying is going up instead of eroding in value? Keep that in mind. All right, so you're going to do these things for income. And so what if you did this 12 times or monthly for the year? And what if, a lot of assumptions, I understand that. It is a game of assumptions. That's what options really are at the end of the day, probabilities. It's a game of probabilities. But what if you average $10 net credit each month? That's approximately $2.50 a week for 50 weeks. Let's say you took 2 weeks off of vacation that you're not trading that year. You're not paying any attention to this. So that equals $125 a share. $2.50 a week times 50 weeks is $125 a share times the 100 shares is $12,500 in income off of one lot of 100 shares of MicroStrategy. And quite frankly, you don't even care what the shares are going for a year from now. You're doing this for income. It's kicking off $250 a week to you, week after week after week after week after week after week. Your goal is to hold on to the golden goose. Don't go cook the goose for Thanksgiving dinner because you ran out of turkey, right? Keep the golden goose that's laying the golden eggs. The golden goose is the 100 shares of MicroStrategy. Your goal is to keep those at all costs. Sometimes you may be able to roll them and collect a much higher premium than what I listed. Other times you might have to roll them for net even and you don't make anything that week or month. Just realize there is some risk in it. As long as you're keeping an eye on that extrinsic value, the likelihood of being called out early on your shares is very, very low. Less than 0.9% chance of being called out early. And what you're doing is you're generating income this way for the entire year. I hope you found value in this. I gave you a few different choices along the way. You could either A, do a defined risk trade, buy the shares, sell the call, and let the shares get called away and make the $3,440. B, you could instead let it expire worthless if it doesn't make it over 400 and turn around and do it all over again and sell the call even a little bit lower this time and still make a profit, still make a $3,000 profit in the example I gave you. Or C, you could do this regularly and roll it every month or so, collecting an additional, call it $10 in premium, and you make about $12,500 for the year. If you want to learn how to do things like that, make sure you book my Understanding Options course. You will understand options inside and out. If you want to know when to time these trades, what to look for on the charts, make sure you take my TradingView and Technical Analysis course. And if you've already done those and you're just trying to get that last question answered, to get over the hump, to get that confidence that you need to really rock this thing, book an appointment with me at gdinerocoaching.com. That's where the courses are. That's where you book appointments with me. You can see here a lot of folks that some of them made a few $100s, others have made 5 figures a month. I've got one guy that's consistently making 5 figures a month, and the way he's doing it, it's a decent sized portfolio. He's doing it with covered calls and selling puts at the end of the day. So again, make sure you've liked and subscribed to my video channel. Make sure you subscribe to this YouTube channel. Like this video, comment below. What'd you like best? What can I do better? I constantly am striving to do better to help you and your family achieve that financial freedom by increasing your financial literacy at the end of the day. So thanks for tuning in, guys, and we'll see you next time.